Well, now that we've introduced debits and credits, let's go ahead and account for a couple of transactions using debits and credits, and we can compare that to the pluses and minuses accounting that we saw earlier. Here we've got the pluses and minuses accounting that we saw earlier, and then at the bottom we've got the debits and the credits. So the transaction we were looking at for January 1st, where we received $1,000 in business checking from an owner's personal checking account. Earlier, we plussed up the cash count by $1,000, and then over in owner investments, we put a plus 1,000. Well, here, it's going to be a little different. Since one of our rules said asset accounts, such as cash, they're always debited to increase the account. That means we've got to put the 1,000 here. Now, another one of our rules said that in any given transaction, the debits have to equal the credits. So for this one, we know that the other account affected is owner investments. Since we have a debit over here, we've got to put a credit over here. And the accounting equation is in balance. The 1,000 equals 1,000. In the second transaction on February 1st, when we were using pluses and minuses, we said that we received $500 in the business checking account by charging $500 on the business credit card. So here in the cash count, we put plus 500, and then over here in liabilities, we put a plus 500 because our liability account, in this case the credit card account, it also went up by 500. Now with debits and credits, what we're going to do is we're going to start with the cash account. We remember the rule that says all asset accounts, of which cash is one type of asset account, to increase it, you have to debit it. So we've debited the cash account 500. The other account affected is the liabilities account, and we know that in every transaction, the debits have to equal the credits, so we have to credit the liability account so that our debits equal our credits. And the accounting equation, of course, is in balance. The 500 over here equals 500 over here. In the third transaction, where we paid $400 from business checking for coffee received from a vendor, when we were using pluses and minuses, we put the minus 400 here in the cash account. And then we knew this was an expense, so we went over to the expense account over here and we did minus 400. Now, when we use debits and credits, we'll start down here with the cash account. We have to remember that rule. If we want to increase an asset account, we debit it. If we want to decrease asset accounts, we credit them. So we had to credit the cash account 400. And then way over here in the expenses account, since we used a credit over here, we've got to use a debit over here because the debits have to equal the credits for every transaction. So expenses were debited $400. The last transaction that we're going to walk through using debits and credits is the fourth transaction on April 1st, when we received $600 in business checking for legal services performed for a customer. Now with pluses and minuses, we started with the cash account and we put the plus 600 there, and then we knew that if we are providing goods and services to a customer, that's called revenue. So we went over to the revenue account and we put plus 600. Now with debits and credits, we're going to again start with cash, and we're going to remember the rule that says if an asset account has increased, we need to debit the account. So we've debited cash 600, and then over here in the revenues account, we credited revenues 600 because the debits have to equal the credits in every transaction. And what we can notice here is the effect of all four transactions that we just went over. We can see with cash, we had some debits, we had one credit. Now if you subtract the $400 credit from these other debits, you have a cumulative balance of $1,700, and we can call that a debit balance. Earlier, we would have called that a positive balance as opposed to a negative balance. But now that we're using debits and credits, we're going to use a different terminology. We're going to say that the cash account as of April 1st had a debit balance of $1,700. We did the same thing with all of the other accounts. We just added up the debits and credits to get to the total as of April the 1st. In this case, we just had one transaction for each of these accounts, so it was easy to add up. Okay, now that we've accounted for these transactions using debits and credits, we can prepare the financial statements, and we can do it in the same way that we did earlier with pluses and minuses. All we're doing is taking the left side and the right side of the accounting equation, all these accounts, and we're presenting them down here on the balance sheet turned 90 degrees. So the left side, the assets, becomes the top, and then the liabilities and the owner's equity becomes the bottom. So these numbers feed right in from the totals of our debits and credits. 1,700 comes in here. We've got the 500 in liabilities coming in, and then we have all the owner's equity accounts flowing in here to the 1,200. And just as we expect the left side of the accounting equation to equal the right side, we expect the total assets here on the top to equal what's on the bottom, which is the liabilities plus the owner's equity. Now, moving on to the income statement showing us financial performance for the entire period of time. All we have to do is pull the revenues and the expenses that occurred throughout the period, and we see that at the bottom, the 600 in revenues and the 400 of expenses. Those just flow straight down, and then when we subtract 400 from the 600, we get the $200 of net income here calculated at the bottom.